So I just got back from a run and was wondering, could the entire crypto ecosystem and economy collapse? Like literally all of it. Tokens, NFTs, the entire nearly $900 billion market cap, everything collapse. It would literally be the size of Tesla just going bankrupt in this recession. And while that sounds like a lot of FUD, there are three very important things that you need to pay attention to so that way you could identify red flags of that kind of potential for collapse happening. We're going to talk about them right now. But let me tell you here, folks, you're going to want to sign up for life insurance after you hear this one, which you can do in as little as 5 minutes by going to metkevin.com/life. I have it. My wife has it. It's so easy to get. It's kind of inexpensive too when you're younger, but go check it out, metkevin.com/life. But when you hear these three things here, you're also going to want as much cash as possible to protect yourself or buy the dip, which if you go to metkevin.com/tasty, you can get $200 for free if you deposit $2,000. That's a 10% return on your money in just 3 months. If you deposit your money over there for 3 months, try it. It's an amazing brokerage, metkevin.com/tasty. All right, so let's now get into the first of 3 potential catalysts for the doomsday. The first is Ethereum 2.0. Now, I know what you're thinking. Oh my gosh, here we go. Another uneducated potential Ethereum 2.0 withdrawal FUD story. Well, actually, what we're going to do is we're going to refer to an article from Data Always, who is a superior Ethereum bull and has some incredible analysis. And we're going to talk about some of the arguments that he makes, and then we're going to connect these with potential conclusions in terms of what it could mean for Ethereum, okay? So let's talk about this. In case you're not familiar, which you should be at this point, but that's okay, in case you're not familiar at this point, Ethereum 2.0's merge is possibly going to come at the absolute worst time for the crypto economy. Ethereum 2.0 is designed to coordinate the network into the beacon chain by slowly making it impossible to mine or validate crypto through proof of work, and instead, we'll be going to proof of stake. So no more dirty mining, we'll be going to staking, starting likely at the end of 2022, with sharding following in 2023. And no, I didn't say sharting your pants, but if you're worried about your pants, you can always go long by checking out the amazing programs on building your wealth with a coupon code expiring tomorrow as we raise the price again. Dang, how is that for 3 pitches in 3 minutes? But folks, today, we have over 9 million Ethereum tokens locked away, waiting to be unlocked, hence locked away, waiting for the beacon chain. And this sets up for a massive potential danger to the crypto economy, which would, of course, coincide with what could possibly be the first great recession since the last great recession in 2008. And given that crypto has never lived through a recession and instead was born out of a recession, ignoring obviously like the 6-week pandemic recession we had, this is interesting. Ethereum merge ain't coming at a great time. Now, the developers of Ethereum are acutely aware that by having 9 million Ethereum tokens locked away and then allowing them to unlock upon the staking or the move to proof of stake may flood the market with Ethereum at quite literally the worst possible time. As such, Ethereum developers are considering limiting withdrawals to 2 types of withdrawals. First, partial withdrawals, where validators will be able to draw down to 32 Ethereum, the minimum that you need to be a staking validator, and basically draw down any of the excess. And with current estimates of the amount of excess Ethereum staked per validator, which isn't actually that much over 32, Ethereum validators who want to partially withdraw from the network could probably do so in about 12 to 15 days. Now, of course, there will likely be some form of limit on the system in terms of how many withdrawals we could see each day, and a certain number of withdrawals per epoch, and there are 225 epochs each day. And the current estimate, according to Data Always, is that we could see somewhere around 800,000 Ethereum dumped on the market each week for 2.5 weeks. But our trading volume right now sits around 4.9 million Ethereum traded per week. So really, adding 800,000 Ethereum for a couple weeks would probably only represent an additional pricing pressure of about 16% of supply for about 2 weeks. Now that could lead, if you compound that, to about a 35% drop in Ethereum prices because of this excess supply. But the argument that's made in the crypto community is, don't worry, we'll be able to absorb all of that excess Ethereum. Okay, fine, but that's partial withdrawals. And so now, and this is the part that's totally up to speculation, we have to determine how many validators who currently have staked Ethereum, or stakers who are part of validating networks, how many of them are going to fully withdraw from the Ethereum network versus partially withdraw or just straight up hodl. Obviously, if everyone fully withdraws, we'll have problems. But that's also where Ethereum developers will likely have some form of limits. Currently, the limit is 5 validators can withdraw completely from the network per epoch. Remember, there are 225 epochs per day. Now, this limit could change. We might see 10 per epoch at lockup. And the estimate here from data analysts, is the potential of about a supply of 65,000 to 80,000 Ethereum in addition to the partial lockups per day. That, in my opinion, would represent an approximately 10% additional supply hit or an additional availability of 10% on the daily traded volume for Ethereum. That would represent about an additional 10% supply every day for probably the first few weeks of the Ethereum merge, which could compound on top of that 32 to 35% from partial withdrawals. Now, that doesn't again necessarily mean that prices will come down this much, because again, people could be buying the dip and we could see a lot of stability here. And after all, these estimates are being brought to you by a blog post by someone who's really a staunch enthusiast of Ethereum, and they're clearly very well educated in Ethereum. While the writer of these estimates themselves calls themselves bullish, in fact, they say, "I remain as bullish as ever," they do also say that, quote, "a contentious and panicked unlock event with large profit taking could, however, be market destabilizing and a relatively long-lasting event." They're in effect warning you of the danger to come. Now, even though they are bullish because they see Ethereum as a once-in-a-generation investment opportunity, the excess supply that we could see through both partial withdrawals and full withdrawals could substantially destabilize the Ethereum network if we don't have a clean bridge and a limitation on how much people can withdraw from the network. But the market should be able to absorb it, right? Maybe. This is where we get to part 2 of this video, which is the unofficial Federal Reserve, Binance, and FTX. See, Binance, whom today Bloomberg described as the shitcoin casino with empty offices in Dubai and an unregulated gambling coordinator. Boy, that sounds like something a mainstream media outlet would say. But first, I want to thank today's sponsor, Moomoo. Moomoo is an advanced one-stop trading app that makes it easy for traders to do everything they need to trade stocks. Moomoo helps you monitor market movements, perform deep technical analysis, and quickly screen for the stocks that meet your criteria, and ultimately provides a community where traders can also exchange ideas. And they are offering all my viewers up to 10 totally free stocks plus extra free Lucid stocks when you open accounts and deposit money using my link down below. On top of that, they have a 24/7 real-time financial news page that allows you to keep up to date with all the financial news you might need for trades, including curated lists of market highlights delivered every morning by Moomoo's own editorial team, consolidated news feeds from Bloomberg, Dow Jones, Reuters, CNBC, and other credible news sources all in one place, and even a market calendar for events such as earnings reports, IPOs, etc. Moomoo even has 24/7 customer service where you can live chat with their team if you need anything. So get up to 10 free stocks today plus an exclusive free Lucid stock when you sign up using my link in the description down below. Again, link is down below in the description to get up to 10 free stocks with Moomoo today. But anyway, the CEO of Binance just saw his net worth tumble from over $90 billion to just $11 billion. And I did say just $11 billion. That's still pretty incredible, but it represents an 88% decline. But anyway, these two firms, FTX and Binance, are arguably the biggest in the crypto space. And you know what they're doing? They are swooping into the rescue when we have problems in the crypto space. It's literally exactly what they've been doing. As one of the largest crypto hedge funds, 3AC, with up to $1.18 billion of assets under management, as that hedge fund completely disappeared because they probably lost all their money, and all that 18 bill went up in smoke, especially when in May they told us they only had about $3 billion left, and now they're not even answering their Voyager Digital margin call, which that's a whole nother story. Who comes in to the rescue? Again, the unofficial Fed, which I call the unofficial Fed, FTX, and Binance. There's a problem with FTX and Binance, though. I'm going to talk about that problem in a moment, but I just want to hit on that tangent with Voyager Digital. Voyager Digital, the Canadian crypto exchange, had about $2 billion, Canadian dollars, in lent crypto, but of that, 666 million, so basically a third, was being lent to one hedge fund, 3AC. That means they took customer deposits and literally 33 cents approximately out of every dollar they received, they lent to one hedge fund. That seems grossly irresponsible. Like, how could you not diversify more? That's insane. That's way too much risk. Anyway, that led over the weekend Voyager Digital likely to fall under a level to the point where if all their customers wanted to withdraw their money, Voyager Digital wouldn't have it. They were upside down, likely, based on what I saw in the financial statements. Now, FTX and the owner of FTX, Sam Bankman-Fried, came in to bail out Voyager with a substantial loan of somewhere between $300 to $500 million. The owner of FTX has about a 12% stake in Voyager Digital, with a cost basis of about $2.34 for a stock that's now trading for roughly 50 cents. Ouch. This is important to know, though, because what does it show you? It shows you that companies like FTX and Binance, even though they're trying to be the unofficial Fed, there's a chance they're throwing really good money after bad. Even Binance got burned for an amount of $1.6 billion on the Terra Luna explosion, or implosion, I should say. And these companies right now are going around trying to prop up as many different companies as possible, even FTX now providing financing to BlockFi, and rumors circulating, including this email that happened to come out of nowhere, that even BlockFi might be running into some trouble after getting a bailout from FTX. Yikes. But anyway, when companies act as a de facto Jerome Powell, what they do in the short term is they prop up coins, they prop up tokens, and they prevent bankruptcies from happening that should happen. The problem with FTX and Binance, though, is they don't have a money printer. And while BlockFi, Coinbase, Robinhood, and many firms are laying off individuals, Binance is pretending they're hiring people. Not actually hiring people, because apparently Bloomberg questioned the authenticity of this, and the staff at Binance said, the photo of the CEO of Binance photoshopped on a model with him hiring, that was just a joke. Folks, I don't know about you, but I feel like we've got two Goliaths, Binance and FTX, both of which have a lot of power in the crypto ecosystem. And if they run out of money because they keep making investments that aren't that smart, like throwing money into Voyager Digital at $2.34, well, then at some point they're going to run out of money. And if the CEOs run out of money because they spent all their money on bailouts for the rest of the crypto economy could face some massive pain the next time we see liquidations of the magnitude that we saw over the last few weeks, with billions being eradicated in 24-hour periods. So buckle up, especially if that same sort of liquidation event happens around the same time that we see the Ethereum 2.0 merge. But that brings us to FUD case number 3, stablecoins. Now, I've warned about stablecoins since the end of 2020, and the fact is they absolutely mask the true amount of leverage that is in the crypto ecosystem. Most advocates of stablecoins like to say that, well, I have USDC, I could redeem it for $1 at any time. And while it's true that $1 of USDC is technically equal to $1, it is not true in the event of a panic. That's because when you deposit $1 into an exchange for a stablecoin, yes, you have the right to that $1. But most people who have money in USDC enable yields. Yields are only possible when you actually agree to lend out your money. You're lending your stablecoin. Don't kid yourself. It is not redeemable for $1 if it's lent out in a panic. Your stablecoins are not a savings account. They are an IOU. And as long as markets are going up and things are stable, your IOU can be cashed for $1. But if you're just the 20th IOU in a chain of IOUs called rehypothecation, and the last person in the chain is an $18 billion hedge fund like 3AC, your stablecoin IOU may end up being worthless in the event of a crypto collapse. And this is where I believe we face a massive triple threat in the entire crypto ecosystem. The Ethereum 2.0 merge coming in a recession is absolutely the worst time possible. It should be delayed. Number two, the Binance CEO and the CEO of FTX are going to run out of money at some point. If they have to keep bailing out companies, there won't be any money left because there is no money printer. And then liquidations will cut deep because nobody's bailing it out. And number three, when true panic comes, stablecoin leverage will finally get exposed. And folks, this is why I urge you to be cautious. I'm not here to FUD, I am here to provide perspective. And if you haven't thought about this triple threat, consider sharing this video and helping somebody else be aware of it as well. And if you have comments to add, leave them down below. Check out those courses with the coupon code expiring tomorrow, link down below. And folks, we'll see you soon. Bye.